Thank you so much, and thank you everyone for attending and excuse me and dialing in online. Um, Happy to be here. As I said, Randy Smallwood. I'm a geological engineer, so I work on the technical side. And created Wheaton as the logo here represents 20 years ago. So we just celebrated our 20th anniversary. We're a Canadian company, founded in Vancouver, Canada. That's where I call home. Although I do have a flat here in London, try and get over as much as I can. We're listed on the Toronto Stock Exchange, the New York Stock Exchange, and about I guess 4 years ago, listed on the London Stock Exchange because the product that we deliver, we think, should be desirable to the UK market. And I'm trying to move this forward and
Down.
down.
Yeah, perversely.
Sorry, I don't have my glasses on.
That one there.
Oh, the one above the down. Not the down. So yeah, enough about that. There will be some forward-looking statements made in this presentation. I urge everyone to understand the risks with those forward-looking statements. They're buried in the fine print there. So, what is Wheaton Precious Metals? Who are we? What do we do? We created a unique business model that has had immense success. We created what's called the streaming model, and it looks a lot like a royalty model, but it's got a lot of advantages and a lot of additional value that is created. And so it's kind of replaced the royalty model, at least in the precious metal space in the mining industry. And what it allows us to do is we supply capital. Our business is we're a service provider in the mining industry, and we supply capital to mining companies. But we do that for a share of the metal that they produce. And because of these streaming contracts that we sign with these companies, we can go to the copper miners of the world, the lead zinc miners of the world, the gold miners of the world, and we approach them to buy a portion of the metal they produce. And in the ideal situation, it's a non-core byproduct. You might not realize, but most copper mines around the world produce a bit of gold. Most lead zinc mines produce silver as a byproduct. It's not the core reason that the company is there, but it comes out with the metal. And so what we do is we approach these companies and purchase the rights to a percentage of that. Now, the fact that it's a percentage of it means that we take some project risk. So we need to be intelligent and thoughtful about which projects we invest into. It's one of the most important aspects of success in this industry because we are taking project risk, geological risk, operational risk, political risk. We try and keep with the operators, but you always have a measure of exposure to that. So 20 years ago, we started, and our original focus was only in the silver space. I became the CEO in 2011. And prior to that, I was doing corporate development and doing all the project evaluations, and quickly expanded into precious metals as a whole, not just silver, but now gold. And proud to say that we've had immense growth since then. We are a dominant gold company. So, but in reality, what it comes down to is why I think we've had such success is because we don't just focus on either just our shareholders. Of course, they are important to us. That's who pays my salary. So we do put a lot of focus on that. But we've got many other stakeholders that are important to our success. Our partners are very important. We're a service provider. We provide service to the mining industry. So we put a lot of effort into trying to make sure that that relationship is strong. And our partners love us when we sign the initial contract and give them an upfront payment to get the rights to this silver. They love it with that upfront payment. But then after that, they've gone and spent the upfront payment, and we get the metal delivered to us at a very attractive price on a per ounce basis. And that's a tougher time to maintain a positive relationship with your partners. But we put, as a company, we put a lot of effort into trying to deliver value on a continuous basis to our partners. But I think the third area and why we've had a lot of success, and to be honest, this is a lot of the reason why we have success with being a partner of choice, is that we also focus on our neighborhoods, our communities around the mine sites. We're the first of any of the third-party investors to actually sit and put hard dollars into the communities around the mine sites. Even though we don't operate the mines, I come from a mining background. I was part of Goldcorp and part of tech. I've worked at a number of different companies prior to starting this company. Social license is incredibly challenging around the mining industry. And so we need to all put effort into it, even though we're not the operators. We're getting a benefit from these assets, from these operations. So we need to make sure we leave good, strong, sustainable benefits. So what that all adds up to is that we've done a really good job of becoming a partner of choice. A lot of growth on that side, and we're getting a lot of repeat business and repeat customers coming back because they enjoy working with Wheaton. So the streaming model, you have to sit and think about a typical mine. Of course, one of the biggest challenges of mining is delivery on costs, right? You can invest into the right commodity, but will the company actually deliver on their cost per ounce? On the capital cost side, is the mine going to cost more to build than expected? Guess what? Most times, more than expected. When it operates, is it going to deliver it for the price it promised on a per ounce or a per pound basis in the case of copper and lead zinc? Guess what? Most times, a miss. The industry has a horrific track record of delivering on cost promises. They miss a lot. It's one of the reasons why the industry is a very challenging one, doesn't attract a lot of investors. That's the risk that we take out. Our costs are defined in the contract. The capital cost on our side is the upfront payment that we make to the Vale, the Glencore, the Newmont, the Barrick. We make an upfront payment to get that contract, and then the contract's in effect, and then the ounces are delivered to us, and we pay a fixed price for those ounces. So there's no cost risk to our investors, to our shareholders. And in fact, when we see a good run in commodity prices, like we have seen in the gold industry over the last well, in my eyes, over the last 20 years, to be honest, we deliver that entire benefit to our shareholders because our costs don't change relative to that. Most of our contracts have fixed prices with a 1% kicker on an annual basis that raises that. So our average cost per ounce, about $450. You'll see it in one of the slides later on. And yet we sell it for the spot price, $2,700 right now. So it's a very, very attractive, low risk way of investing into precious metals. And I would say in today's world, everyone should have some precious metals in their portfolio. Sorry, I kind of went through that one without highlighting. So the predictable costs, high quality assets. Again, I talked about how important it is to be selective about the right assets. A big progressive dividend. We pay you to own our stock. You might think the lowest risk way to own precious metals is to go out and buy bullion or buy the gold ETFs. You pay fees for that. There's no growth, and you actually have to pay to that. Whether you're storing gold bars, you can stick them in the backyard, I guess, or underneath your bed. But we actually pay a pretty healthy dividend. A large portion of our revenue goes back to our shareholders. About 30% of our revenue goes back to our shareholders. Now, our share price is doing very well, so it's not big on the yield side, but that's because we give you good quality exposure to the precious metal prices, and that's why our share price has done so well. Commodity price leverage, we do have that base production payment, $450 an ounce for gold, about $4 and some odd cents per ounce for silver, and a couple of other accessories. But we deliver, as I said, all the benefits of a traditional good mining investment, the exploration success. These deals are for life of mine. So as a company continues to explore, we continue to get that benefit going forward. And of course, optionality. We've got a number of projects that aren't even part of our current production plan, which is incredibly exciting. But there's a number of projects that still aren't even part of that yet. They're still waiting for permits and for construction decisions. A couple of highlights. This is one that always shocks people. Our market cap is about 30 billion US. We have 42 employees. And it was 41, but one of them went on maternity leave. So now we're at 42 right now. It's so nice running a company like this where I know the name of everyone in the company. I know their partners' names, and I know most of the kids' names, right? It's a very tight, well-known, closely knit company in terms of how it goes forward. Our cash flows, I think it's in there somewhere. We'll be doing over $2 billion in cash and cash equivalents at the top, close to $700 million at the end of the third quarter. We'll be doing this year, we'll probably just break over $1 billion in free cash flow. It's a very powerful company. We've had incredible growth going forward. We do really put a lot of focus into ESG. We are actually ranked in the global top 50, and that's in a multi-sector analysis. That's counting banks, that's counting tourists, that's counting everything. The amount of effort we put into trying to improve our partners, our neighbors around the mine sites experience is something that makes a difference. What's most exciting about where we are right now, I've been with the company since we founded it 20 years ago, is we've got an incredible growth profile. It's actually, it says 40 there, but we've just announced a couple more transactions here in the last month that will push us up probably more than 50%. Should get us very close to 1 million gold equivalent ounces per year of production. I think given the amount of time I've got, I better get going. Our asset base, 18 different mines delivering metal to us right now. We're America-centric. Remember, we were started in Vancouver. Remember that we started in silver. Silver for the first 10 years. The Americas is a very important part of silver. Mexico and Peru are the dominant silver producing countries of the world, that and China, but for us, China is uninvestable. And so very centered on the Americas. But we've now got 2 investments into Africa. We've also been longtime investors into Europe. And we've got last year our first investment into Australia. But it's a pretty low political risk investment portfolio. It's something that's really important to us is because these are life of mine transactions. We've got mines that have 50, 60, 70 years of reserves in front of us that we will be invested into on a go-forward basis. A couple of the big ones are our flagship is the Salobo copper mine. It's not only our biggest producer, but it's also the biggest copper mine in Brazil. It's the flagship of Vale. Vale is really known for iron ore. Anyone would know them as being one of the largest iron ore companies. They compete with Rio Tinto and BHP. But they have some incredible base metal assets. Vale is their flagship. And we get 75% of whatever gold that mine produces forever. There's well over 40 years of reserves and resources there, and they haven't found the bottom of the ore body yet. The ore body just keeps on going. So I think we're going to be getting last year was a little bit of a tough year. I think we got just over 200,000 ounces of gold from that mine. We should be up around 250,000 ounces of gold this year from that mine. It's a very high profile mine. Vale, a big company. Why do they need a company like us to supply capital? We gave them $3.1 billion to get the right for the 75% of the gold from that mine forever. Vale is still making incredible money there. About 80% of the value from that mine is copper. They get 100% of that copper, plus they get the residual 25% of the gold at spot price. So Vale, from their perspective, they spent about $4 billion building the mine. We paid a little bit over close to 80% of the capital required to build the mine. We're taking away about 20% of the revenue, but we do it for life of mine. It's very attractive for them. Their shareholders' return on invested capital, very strong. For us, an incredibly profitable mine. We get this gold at $400 an ounce. We turn around and sell it at $2,700. So, and all the other mines, Antamina with Glencore in Peru. We've got Peñasquito in Mexico with Newmont. Just very high profile partners, but also a lot of small companies. The mining, we're blessed. We've got an industry that always needs capital. It's usually the small companies that need the capital. The big ones have operating cash flow, but there are times in this industry when the big companies get over levered. They have too much debt. They need to get rid of the debt. They sell some of their non-core byproduct precious metals to us, and we push that forward. So you can see Glencore, Vale, Barrick, Hudbay, Lundin Mining, all large companies, but a lot of small ones. It works across the entire mining industry. The next 2 slides, I think, are the 2 that hopefully resonate the most. The focus on quality. I'm not really, our margins, we're close to 80%, our margins, and they're fixed and prescribed. Every asset, it's the same, right, in terms of the production payment. What I'm most interested in is how profitable are my partners, because they're the ones, the operators, the ones that are actually investing back into the mine, spending exploration dollars, spending expansion capital, and so on like this. 93%, 71% in first quartile, 22% in second quartile. So 93% of our production from 18 different mines is in the bottom half of their respective cost curve, which means if it's a copper mine, it's in the bottom half of the copper cost curve, the worldwide copper cost curve. These are the most profitable mines in the world. They're the ones that will continue to grow and expand. So this quality, there is not another precious metals company that can say that with 18 mines delivering metal to it, 93% of that in the bottom half of the cost curve. Everyone's got high cost assets in their portfolio. We have a few, but not much. They're all very profitable for us because, again, we have that fixed production payment. But this is more about our partners' health than ours, and that's a very important factor in terms of success. The other advantage we have is most gold companies, most gold mines have relatively short reserve lives. They have lower capital intensity, so they don't need to spend a lot of capital building out reserves and stuff like that. Average reserve life at a gold mine, 10, 15 years. We take gold from the base metals industry, copper and lead zinc mines. Those mines, much more capital intensive. They need to drill off 30 to 40 more years of reserves to justify the investment before they build these very, very expensive big copper mines. We bring in proven and probable reserves, 28 years. There's, again, not a precious metals company in the world that gets probably over 25 years of reserves in front of it. 20 is probably the max. And so we're taking one of the best attributes of the base metal mining industry and bringing it into the precious metal space in terms of the reserve and resource life. We have over 60 years of combined reserves and resources all the way across. A really good, strong portfolio. But this is perhaps what's most exciting about our company. As I said, this year, we'll be doing about 600,000. The guidance was 550 to 620. Our Q3 results sort of show that we are definitely going to be in the higher end of that production guidance. I'm going to say we're probably around 600,000 ounces. This graph does not include the two most recent acquisitions that we've made. And so by the time you stick those in there and push this out, by 2030, 2031, we should be up very close to 1 million gold equivalent ounces per year. So strong growth and very consistent growth. Keep in mind, we've got 18 mines delivering us metal right now. Excuse me. 5 of them will be key contributors to that growth over the next while, along with a lot of new mine constructions. The top 4 mines in the greenfield area, they will be delivering metal to us by the end of next year. So an incredibly exciting time where we're going to start seeing a real ramp up in production growth. And when you consider the trend for gold prices, I can't pick a better time to be dramatically increasing our production, because that increase in production combined with an increase in gold prices will deliver very well for our company. We're incredible capacity. In fact, this gives a bit more detail about it in terms of confidence level. Operating assets, you can see 5, but 80% of our production is either permitted, in construction, or already operating. So it's high confidence. They're going forward. 20%, the Marathon and the Copper World projects are still waiting for their final permits. But Copper World is actually very close. They need one more permit before they start construction, and it'll come into that too. Excuse me. This is the beauty of the streaming business model from an investment case. There's no risk on the cost. We don't have a cost curve. We have a nice straight line that just runs out. That this is our cost, this is our margin, that's our profit margin on a per ounce basis. This is silver on the bottom, that's gold on top. When we sign deals, I will say that there has been a slight change in how the deals are structured. Anything we did after about 2018, the production payment is now a percentage of the spot price. It's not a fixed amount. So it's 20% of the spot price, which means that for every one of those ounces, we make 80% on an operating basis. But that's the beauty. Now you can imagine where the price is going to go, but our cost does not climb with that. That's the challenge that the normal mining industry has, is that whenever prices go up, the costs chase those prices. So cash flows. As I said, we're generating close to $1 billion. You can see here, it's tough to sort of carry it all the way across the graph there, but at current prices, rough current prices there, over the next 5 years, we'll be generating close to $8 billion in cash flow. And then you can see the optionality that we have with increases from the base case over and above. And we do have leverage. If there's a 50% increase in commodity prices, we see a 60% increase in our operating cash flows. And again, because our base costs, our operating costs are fixed, that's a promise that we can keep. It's very easy to keep. And in fact, we're perfectly set up. Back in 2010 to 2013, we had a real good run up in gold and silver prices. Keep in mind, we were a silver-focused company back then, but we generated a couple of $1 billion of surprise capital over that very short bull run. Now we're producing over twice as much, and I think we're on another bull run in terms of commodity prices, so we're set up very well. This is kind of a neat stat. Last year, we surpassed in cash flows the amount of money we've invested into our assets. So we've actually reached payback. And so now it's all gravy. Now it's all over and above. We'd invested pretty close to $10 billion. In fact, now it's over 10 with some of the other commitments that we've made here recently, but we're well over $10 billion now in cash flow. So everything from going forward. And I just want to highlight, we have 60 years of reserves and resources to still go. This is only 20 years. We've still got 3 times as much as this to go forward. So it's a good, strong business model. Dividend, we deliver more back to our shareholders than anyone else in the precious metal space. As you can see, close to 30% of our revenue goes back to our shareholders in the form of the dividend. Now, our share price has done very, very well, so it still has our yields down on the 1 to 2% range. I think we're down close to a little bit over 1%. We have recently, though, changed our dividend policy to being a progressive one, which means we will commit to growth every year. It's going to depend how much cash we've got on hand. The more cash we've got, the faster the dividend's going to grow. The less cash, that means we're investing it back into the ground successfully, then we will maintain a bare growth rate. But that's, that's the whole focus. I better hurry up here, right?
No, you're doing fine.
Okay, great. Benefits to why do companies do this? It looks like, wow, how come Wheaton is so profitable? Why do mining companies still do streams? It's because the equities in the mining space are so undervalued. They trade at a discount to net asset value. And yet when they come to us and look for capital, they can either issue shares that are incredibly dilutive. If their equity price is below net asset value, when you issue shares, you're diluting your existing shareholders. Sometimes we need to remind them they're working for their existing shareholders in the hope that they stay future shareholders. You don't work for your future shareholders, you work for the existing ones. And so a stream delivers so much more value on a per ounce, per value basis. We value a stream close to net asset value. And so it's incredibly attractive, especially right now for single asset development companies to do streams going forward. And so the key advantages is, of course, that arbitrage. When we bring it into our portfolio, it's worth a lot more. That lack of cost risk really does give us an advantage. So if it's a development company, we split that value with them. If it's an operating company, there's not as much value, but we still split that with them. And that's just because the developers are always undervalued relative to what the producers are. The Smallwood example I already talked about. We delivered 80% of the capital to build the mine. The Vale investors were very happy with that. They only paid less than $1 billion to get that mine built. They generating over $1 billion a year in EBITDA from that mine. And again, a 40-year life going forward. So it's a win-win situation, the best type of business transaction. To the community, we put a lot of focus on this. This is something that I'm quite proud of because I came from the mining industry and I know how important it is. And I never wanted to be that royalty guy because the royalty companies, very, very ugly to deal with. Never enjoyed working with them when I was in the mining industry. And so our whole concept here was to change our company to be different in terms of delivering back to our communities and working. So we put a lot of effort into this and it shows in terms of how we're ranked. We put 1.5% of our average net income. We do spread it over 4 years, but with our, this number is actually growing quite substantially over the last while. We put it back into community efforts around all of our mines and our development projects to again help our partners gain stronger social license so they can keep operating. This is something that has been very successful, very successful. I'm quite proud of what we've done because we've forced the royalty companies to now do this too. Should have been doing it years ago. So a couple of highlights, but we get recognized global top 100, ESG global top 50 rated, one of the highest ranked resource companies in the world in terms of what we give back to our communities around and how we focus on that. So a couple of quick slides here. Why gold? All you have to do is think about, you can't talk about gold without talking about the US dollar, and that should be enough to actually say why gold. The US dollar, the reserve currency of the last 100 years, for the first 50 of those 100 years, it was backed by gold. Since 1971, when Richard Nixon realized that he couldn't spend his way out of his challenges and unleashed it from gold, it's been continually, slowly collapsing, right? And so what we are seeing is on a worldwide basis, central banks, sovereign wealth funds, investors funds and all that, getting concerned about US dollar as a long-term store of value, as a reference currency. And so gold is really truly filling that role. Quite literally, since about the year 2000, right in about this area here, as you can see, there's been some volatility, and there will be volatility. We just saw a very strongly decided election in the US that's going to add some volatility to the world. But that's a pretty strong trend on a go-forward basis in terms of what we see. So gold should be part of everyone's portfolio. The question is how much of that portfolio. In my eyes, hard assets need to be the bulk of your portfolio. What do we do compared to the other streamers? We are pure precious metals. We get a little bit of cobalt from one of our mines, but 98% of our revenue comes from precious metals. It's mainly gold and silver. And so we deliver that. And we're 100% streamers, which means that we have healthy operating margins, levered cash flows, or levered exposure to the commodity price. So, in fact, as I said, we are by far the three senior. These two are royalty companies that have converted into streaming companies. Now, probably 60% of the revenue comes from streams, but we are essentially pure precious metals. So, I think these two last slides are summary, and I would like some questions. So I'm going to open it up to questions, please.
Thank you very much. There are a couple of questions online, which I'll start with. Otherwise, I risk forgetting them. Hold on. So from Mark Bentley, what are the principal criteria you use to decide which projects to invest in?
Yeah, the first one is the operating margins for the partner. That is the most important part of our decision process. Now, mines change over time, and you can see we do have like 93% is first and second quartile, but we do have 7% second quartile. Some of these mines have matured, and the cost of the grades are down, and the costs have climbed, and so on and stuff like this. But we are a bit unique, again, compared to the royalty companies, in that we focus on our portfolio and we look at it. And if there's opportunities to sell or close or collapse a stream and pull some value back so that we can actually put it into other projects, we will. 3 years ago, we sold two mines that had both been in our company for 15 plus years. Both of them we had 10 great years with, and then they got a little bit tired and they were higher cost. And we just said, you know what, it works. It's better for us, especially if we can pull good value out, crystallize that and reinvest it. So it's the operating margins. Our whole focus is it's got to be first and second quartile of the respective cost curve. After that, I mean, political risk comes into play, but there are ways we can temper political risk, especially if you're dealing with a big diversified company. You can use a corporate parent level guarantee to protect yourself. One of our peers had a challenge more recently in Panama with a copper mine that got shut down by the government, and they did not have a parent guarantee. Every single one of our mines has a parent guarantee from whichever company we're dealing with. Now, sometimes it's a single asset company. It might not be worth much, but our parent guarantee transfers in the event that that asset gets acquired. So political risk comes into play. But really what it comes down to is if our partners aren't healthy, we're not healthy. So we need to make sure that they're strong. So the first thing is the operating margins for the operator.
Thank you. Same questioner. I'm a shareholder in Ivanhoe, which for the benefit of other delegates is the developer of Platreef, which is one of your greenfields.
Yes.
What are your thoughts on that project, please?
It's going to revolutionize platinum and palladium production out of South Africa. It is an incredibly, Mr. Friedland, Robert Friedland, who I know personally, you're lucky if you do it once. You're good if you do it twice. I think he's on number 4, actually, in terms of good projects. He has an incredible knack for unlocking some of the best mineral resources in the world. And Platreef is one of those. It's unique. Most platinum and palladium comes from very narrow underground reefs, they call them, 60 centimeters, like very dangerous shrinkage strip. You're sending people up into the workforce up in there to basically knock it out and try and minimize dilution. Incredibly expensive and most importantly, unsafe. It's one of the reasons why the South African mining industry is such a challenging industry. The Platreef development is a mass deposit. It's 40 meters thick. It's 1,000 meters down. So they do have to build the shafts to get there. That's why it's taking so long. But by the time they get to full production level in 2031, at 10 million tons per annum, they're going to be producing so much platinum and palladium under there, it's probably going to shut down the rest of the South African platinum and palladium industry. It's just such a game changer, and not only from an economics perspective, but from a safety perspective. Mass mechanized mining where you're sending equipment into the dangerous spots versus manpower or people power, incredibly important. And so very happy to be a part of that.
Just for my benefit, the structure, so as if I understand it correctly, these are options on future production rather than an obligation to buy future production
Well,
at a defined price.
yeah, although we would always take it because our defined price is always below or equal to the spot price. Our contracts actually have a clause that says that if gold goes down below $400 an ounce, we pay that spot price. So we can never lose money on it. So you're right, we don't have to accept it, but it would be foolish for us to not accept it.
And
So,
the strike price that you set is based on first quartile costs for gold. What's
no, it's a negotiated price.
Okay.
So there's the value in a gold production from a copper mine. We look at it as being, all the way from the spot price down to zero. We divide a portion of that to the production payment, which is going to be paid over time. And then the rest of it is valued to the upfront payment. So depending on what the spot price is, currently spot price is $2,600 to $2,700 per ounce of gold. And our production payments are down around the $400 range, $450 range. And so we will discount value that incremental difference back to and that's how we calculate the upfront payment.
Thank you. I think, Mark, you had your hand up.
You partly covered it. So effectively, you're taking some, or on the old style, you're taking some economic risk on how the mine works, if there's a strike, if production costs go up, and so on. And on the new one, you're simply paying 20% of the spot as it moves around.
Mm-hmm.
And then the difference between that 20% of spot and the production cost is not your problem.
That's right. Yeah, exactly.
But if there's,
I would say even the old ones, the same risk is there. If the mine goes on strike, we don't get metal production, and there's no obligations. There is one of the attractions is that there is no minimum deliverables. But if you choose good mines, that can be a real positive for us.
Yeah.
We've been in business now for 20 years. Our exploration success has replaced the first 19 and a half years of production. So you think of mines and they have limited ore bodies that you essentially exhaust. Exploration success has just very close to replaced every single ounce we've ever mined. And so that's the upside that we're chasing by choosing good mines. Is you take that production risk. There's no minimums that they have to deliver. They have to build the facility to a certain capacity, but then after that, we do share the operating risk. But again, it comes back to making sure you invest in good mines. And then that operating risk is actually an operating reward.
okay. And what IRR do you price to when you put out money?
Every asset is different.
Yeah.
If it's an operating asset in a stable jurisdiction, on a flat level price, what I promise my shareholders is that I'll get you high single-digit returns on a flat commodity price. Now, you get the optionality of higher commodity prices, which we've definitely seen since we created this company. So that's not part of our value proposition when it comes to doing transactions. We don't invest based on a higher price. We invest actually on a backward curve. And so high single-digit for operating assets in stable jurisdictions all the way to the transaction we just did down in Côte d'Ivoire in West Africa, we're around 15% on that one. That's again on a flat price. And so take the price and run with it. And if the exploration success that they should have on that project and will do very well, our average return to date on an annual basis to our shareholders, 18-19%.
Okay.
So.
And just final question before I hand the mic back.
Yeah.
I'm still conceptually wrestling with what are the advantages of investing with you rather than buying shares in the mine directly?
Well, because their costs climb. Traditionally, mining companies, as soon as commodity price goes up, material that has less metal in it becomes economic, but your costs are tonnage based and your revenues are metal based, right? And so you're getting less metal on a per ton basis coming through. And so as commodity price climbs, so does cost. And so in reality, most mines, and I'm generalizing, if you don't have low grade material at a mine that becomes ore, then guess what? You will actually do a better job with higher commodity prices. But those are few and far between. Most mines actually have lower grade material that keep pushing on that price pressure. With us, you have that fixed cost at the base. There's no risk of that inflating. So
yeah,
I think
what do you think on
got someone waiting here behind me?
yeah,
sorry.
What do you think on Africa's situation regarding
Well,
Mali?
every country is unique in Africa, as it is everywhere in the world. There's places in South America that I wouldn't invest into. We have a list of probably about 10 different countries in Africa that we think are investable. But we do capture that political risk in our expected returns. The 15% return we're bringing out of the Côte d'Ivoire or Ivory Coast, that's probably the highest return we've ever had on a gold investment in our portfolio. But it's because it's one of the higher risk jurisdictions we're in. It's a relatively stable jurisdiction, but it does come with some risk. And so we're not interested in Mali. We're not interested in Burkina Faso. And, you have to be sensitive to the fact that these are long-term investments. And so what it's like there now, we don't know what it's going to be like in 10 years. And so that's one of the reasons why we have to bring in a higher rate of return for that. So.
Hi, so you get your gold at a discount price, and then where do you sell it?
Into the general market. The beauty of gold is that it's the same everywhere, and so it just goes into a general trading market. Each one of our contracts, we have the ability to have physical gold delivered to us, but the security costs of doing that don't really make sense. And so there's all sorts of banks around the world that have commodity trading accounts where it's like a bank account, but it's measured in ounces of gold, not dollars or pounds or euros. And that's what we use is that gets put in. We can always take physical if we decide to. Just we don't have a big enough warehouse for that. So, and it just doesn't make sense to do that. So it works through commodity trading and it just goes into the general market. So.
Any more? We're still fine for time. Can I ask you two questions? One is how you deal with expropriation risk, or how you consider expropriation risk, and the second is if a mine is abandoned or becomes commercially non-viable, how does your contract survive that, or does it not survive a transfer of ownership?
So expropriation risk is something that we have to factor in, and that's one of the reasons why we are sensitive to that political risk. That's what I equate to political risk. Well, you can have creeping expropriation in terms of higher and higher royalty rates. Again, one of the reasons we invest into first and second quartile assets, because the operators have the capacity to take an increase in taxes or increase in state royalties and still be profitable on a go-forward basis. If it gets to the point where the mine has to shut down, we rely on parent guarantees, and this is something that's really key to differentiate ourselves, because our biggest competitor, Franco-Nevada, just had a mine shut down by the government in Panama, and it was their biggest producer. It was 25% of their cash flow, and the Panamanian government shut it down. They didn't have a parent guarantee. We were actually the highest bidder on that, but when the company would not give us a parent guarantee, we backed away from the deal. We said, sorry, everyone gives us a parent guarantee. And the parent guarantee is just for us to get our money back, because our whole focus is we stream gold, we stream silver, but we don't stream political risk. So we can't take that risk. Now, you can't avoid it to a certain extent, but in that situation, where in Panama, we would at least have a claim against the parent company. First Quantum was the operating company that was running that copper mine, for about $800 million. They invested $1.4 billion. Franco invested $1.4 billion. They'd only received about $600 worth of gold and silver back from that mine. So they were 800 million short. We would have that claim against First Quantum. So that's one of the ways that we control it. The other way that we control it is through a strong ESG community program. I have to say, it's so few dollars, but it delivers so much value back in terms of strong social license locally. And where it really pays off, we've made 10 acquisitions in the last 2 years. We made 2 investments. 2 years, 10 investments, 2 this year, 8 in 2023. 7 of those were with people or companies that we have worked with in the past that came back. We're a service company. The repeat customer is the most important, easiest source of growth, is to have happy customers that come back through your door to come back and more. Out of those 7, 5 of them weren't even competitive, right? So again, it's those kind of contributions that sort of help on the long front, and it helps on the community side. If the mine shuts down, then I get to fire the engineer and the geologist that told me it was a good mine to invest into. Again, first and second quartile, those are the mines that usually don't. We do manage our existing portfolio. If we see weak assets in our portfolio, then we will, take opportunity to crystallize those, sell them off. As I said, 3 years ago, we sold off two assets for net benefit of about $500 and some odd million back to us in payments to get rid of them. But they were third and fourth quartile assets, right? So we do manage our existing portfolio. We want to maintain a high quality portfolio.
Fantastic, Randy. Thank you very much indeed. That was very interesting indeed.
Thank you very much.